Perfectly. Thanks, David. Morning,
Fantastic. I trust that most of you have become familiar with the agenda for these calls. So Iain will take us through a handful of slides that he has put together from the COVID-induced recession at a global level before narrowing down to the local economic story, and then how the portfolio is currently positioned as we head towards the month of May. Some quick housekeeping. At the bottom of your Skype screen, you will see a Q&A tab. So please do post any questions here, and we will aim to get through them with Iain at the back end of the presentation. And a quick reminder that these questions are only viewable by myself and not the entire audience, so please do post away. We have put the presentation up on the screen, but if anybody is having trouble viewing it, we have also added it as an attachment. To access it, there are 3 blue buttons at the bottom of your Skype screen. If you click on the one named Share Content and then go into Manage Content, you should see and be able to download the PDF file there. Before I do hand over to Iain, I think it's worthy to mention that as of yesterday's close, the Balanced Fund is down just 1% year to date, which is testament to the investment team at Truffle and their ability to protect capital during what is clearly an incredibly tough and volatile environment. I would like to now hand over to Iain, who will take you through the presentation. Iain, I am controlling it from my side because you have dialed in. Just let me know which slides you're on and I'll move to that respective slide. Thank you very much.
Brilliant. Okay, thanks, David. Good morning, everyone. So if we can just move forward to slide 2, bringing up the 3 bullet points. I think a good way to open the feedback is really to set the backdrop of what we are dealing with insofar as the impact of the virus, and more importantly, the impact of the measures to control the virus. And I think to the extent that it's now pretty much consensus that we are going to have a recession, and we are in recession. The real question is the extent to which economies will slow, and the amount of damage that will be done to economies because of the measures to control the virus, and then of course how long is it going to take us to recover. I think the points that we would like to just highlight is that, notwithstanding the fact that infection rates are peaking out and the delta in terms of new infections is now starting to decline, I think what is important to note is that there is obviously no guarantee that once we come out of these lockdown scenarios that the infection rates don't then spike up again. So I think to the extent that there is no vaccine, and there probably won't be a vaccine for at least the next 18 months from what we can gather, there is still a huge amount of uncertainty in terms of when we will return to a normalized economic environment, at least getting onto a glide path to get us back to normalization. And I think that really is the big question at the moment. So I think the virus has not only hit demand insofar as people are locked down, but it's also hit supply. And we see anecdotal evidence of inflation in certain goods and services, and then deflation in others. So I think until such time as there is a cure or there is a vaccine, I think the uncertainty levels are going to remain high, just because we don't know how economies will actually come out of this and what is the duration of that recovery period. So if we go to the next slide, which is slide 3, just really showing you the median multiple of the S&P 500, which is around about 15.5 times, and you can see that the market sold off on the back of the virus, but has had quite a sharp rebound. And we are certainly not at levels which we would consider to be cheap at all. So I think the point here is that markets are discounting quite a speedy recovery to what we think is unlikely to occur in terms of a normalized operating environment. We think that it's going to take time for economies to recover, because certain sectors of the economy are going to struggle to get back to normal. If you just think of travel, services, tourism, a whole host of sectors, which is probably going to take a year to 2 years to recover. So markets are certainly discounting quite an optimistic scenario in our case. And as a consequence, we're still feeling, that we want to be fairly cautious and defensive insofar as the portfolio positioning, but I'll talk to that a little bit later. So slide 4 just really shows you the impact in terms of expectations on earnings, and I'll just try to give you a sense here of what the S&P earnings per share looks like going back over time, and you can see that the market is expecting an 8% decline for this year of S&P 500 earnings. We actually think that that's quite optimistic. We think that you're likely to see 20% plus earnings decline, and you can see the ratchet up or the recovery that is expected by the market. And I think as a consequence, that's why you're seeing the S&P 500, and you've seen quite a strong rebound from markets. So we think that the risk here is to the downside from an earnings perspective, and one of the big reasons why we're still fairly cautious in terms of portfolio positioning. So if we just move on to slide 5, just to maybe talk a little bit about tail risks. So we think that tail risks are certainly elevated and will remain high. And I've just tried to put up some of the issues that I think we are likely to see continuing. Certainly the trade conflict or the conflict between the US and China, we don't think will go away. And to the extent that China has not been truthful or fully forthcoming insofar as how they've dealt with this virus and the consequences for everyone else, the rhetoric from Europe, UK, and the US in terms of some sort of sanctions towards China is going to increase. And I've got 2 pictures down there just on these wet markets which have subsequently reopened. And I think the bottom line here is that if China is not going to adhere to, I guess, certain practices in terms of health and safety, we are likely to see this conflict between them and the rest of the world escalate. I think the next point to highlight is that deglobalization, this issue that we've had now in terms of the global lockdown and the impact on supply chains, is just going to further force businesses to try and bring some of their supply home, back to their own country where they can control it. And that is not good for margins, because it's going to come at the expense of the lowest cost geographic destination. And then finally, the little debt ball in the top right-hand corner, more debt is being added to the global economy to try and provide some sort of stimulus or some sort of support to what's happening. And, to the extent that some of these economies are unable to pay back the debt into the future, creates, I guess, the potential for downside. So I think from a SA perspective, everyone would have heard our views over the last 2 years, where we've been saying that South Africa is in its own induced low growth or structurally low growth environment, and I think COVID has just made a bad situation even worse. So to the extent that I think we have limited financial means and a limited ability to support the economy, to the extent that the government's cupboards are already pretty much empty, means that South Africa is in a difficult position. On slide 7, just really to give you a sense of the impact of what the fiscal measures that have been taken are going to do to our debt to GDP. And you can just see that the pre-COVID forecast in terms of debt to GDP was going to take us up to sort of the low 70s. We're now comfortably going to get to sort of the 80% plus debt to GDP mark. And this would typically be an area where IMF and pretty much any world economic body would say that we are entering the realms of a debt spiral. So from a fiscal position, I think it is looking very difficult. And I think to the extent that we've got a situation where the tax base is going to come under pressure in South Africa to the extent of the economic hit, at the same time when the requirement to support the disenfranchised in the country is rising. So it's very difficult to cut social grants. We, in effect, are a social welfare state, and this really is going to result in our fiscal deficit ballooning. So if you go to slide 8 just really showing you the extent to which, if you look at pre-COVID and post-COVID, these are the scenarios that we're looking at. We're looking at sort of a fiscal deficit of 12% of GDP, and effectively that is now the borrowing, the public sector borrowing. Government has to go into markets and then borrow 12% of our GDP to pay and fund its expenditures. And remember, the bulk of our expenditures, a big proportion of them, is social welfare. It's grants, it's child support grants, and the long and short of it is it's not as though we are investing this in productive assets. It's not going into rebuilding infrastructure. It is going into consumption and social welfare. So I think those are the expenditures that are going to be difficult to cut, and now we are going to be building debt into this. So we have already seen the downgrade, so we've been downgraded to junk, and at the end of the month, in the next 5 odd days, we will leave the WIGB, and the global index managers will then rebalance their portfolios, and we're expecting a couple of $1 billion up to $3 billion of outflows. Lots of the damages are already been done in terms of the impact on our financial assets and obviously the rand, to the extent that the rand is over 19. But I think what's important to note is that the backdrop for the SA economy is going to get tougher, and I think the backdrop for the government to fund these deficits is going to be hard, and there certainly are some hard decisions that need to be made. So we've had some calls with many of the global strategists of a lot of the big sell-side brokers, Goldman Sachs, Merrill Lynch, UBS, and they've been engaging with global investors, emerging market investors, and just really chatting to them and saying, from a SA perspective, you've seen the massive hit in the rand, you've seen our asset prices sell off, and what would they be looking for before they would look to start accumulating both our bonds and equities. Now remember, we've had about 70 to 80 billion rands worth of outflows on our capital account this year. That's sales of bonds and equities from foreigners. And overwhelmingly, the investors is they want to see a proper structural intervention from a fiscal perspective in South Africa. In other words, we are spending too much from a government perspective versus the taxes that we are taking in. And that really gets back to the required cuts in public sector wage bill, where we've got bloated civil servants, and we are paying too much in terms of wages. So I think that's really the penny that needs to drop. And I think, clearly one of the avenues that South Africa can follow is go to the IMF. But once you go to the IMF, you then have to impose and effectively hand over control of the economy to the extent that they will then enforce the structural reforms in exchange for the capital and the funding that they will bring. So we think that's probably a last resort because we think that the government won't want to hand over control. So some of the things that we are thinking about in terms of options that they may look at, we certainly think that prescribed assets of some sort of infrastructure bonds, we may well be likely to see the introduction of that. We think that on the capital account, if we continue to see money flowing out, we may in fact see some sort of change in terms of capital controls in that government could either change the limit in terms of our allowed foreign investments, so pull it back from 30 to 25 and really force SA investors to bring money back into the country to fund the capital account in terms of the hard currency effects that the country needs. So these are all, I guess, the uncertainties and the potential, pathways that we could see in the future. And I guess pretty much irrespective of which one is taken, I think the backdrop for us is one of being cautious, making sure the quality in the portfolio is high, and making sure that in this very volatile period environment that we don't lose principal, and we at least manage to hang on to the capital that we've got. So if you look at slide 9, just really giving you, I guess, a summary of SA in terms of risks and opportunities, in terms of the way we see them. And I think it's just fair to say that our view pre-COVID was negative in terms of South Africa Inc. And I think post-COVID it has just become more negative. So what would change our view? And if you look under the opportunity side of the Venn diagram, in the bottom right-hand corner, it's the IMF intervention. I think if we had an IMF intervention in the country, yes, we would probably have a little bit of a crisis going into that. But I think that would be the turning point for South Africa, because it would bring the medicine which is necessary to address the public sector finances and cut a huge amount of inefficient spend on public sector wages. And that is really what we need to do in terms of restructuring the economy. And until such time, we are firmly down the path of a increasing debt and potentially putting us into a negative debt spiral. So slide 10 just gives you a sense of valuations, and these are domestic valuations. So what I've tried to do here is give you a sense of the JSE PE ratio excluding NASPAS, and you can see that we are at fairly cheap levels relative to history, not as cheap as the global financial crisis, but certainly cheap. But I think against this backdrop, what you will be seeing and what we will be seeing is earnings are going to take a big hit from SA-focused companies. You've seen a lot of the banks come out with their trading updates for the first quarter and talking about earnings down, the region of 25% because of potentially higher credit loss ratios. Once the retailers, the industrial companies come out, you're going to see quite a grim picture. I'll give you a quick anecdote. We had a call with Bidvest. Bidvest was just telling us that their monthly salary bill is about 1.6 billion rand across the entire organization. And if you can imagine now, for almost 2 months, when you've got no revenue or no sales coming through your business, but you're still having to pay 1.6 billion of salaries every month, it's going to make a havoc of companies' profits over this financial year. So we're going to see big hits to company earnings. And the real question is, what is the new normal? How many cars will be sold in the next 2 years once things get back to normal? What's going to happen to luxury vehicle sales? What's going to happen to discretionary spend through the retailers? And I think this is where a lot of the uncertainty starts to build in. So from a truffle perspective, we're saying that because of the uncertainty, we want to see bigger discounts. We want our clients to really only take the risks that we want to take. So to the extent that we believe that earnings are likely to disappoint on the downside, we will only buy into a lot of these businesses if the multiples or PEs are discounting a lot of that bad news. So if we look at the portfolio, just to give you a sense of what it looks like, slide 11 just takes you through, I guess, a quick helicopter view of the portfolio today. So we've got net equity of just over 50%. And that is a net position post our hedges. You will recall that we've got a lot of option protection on the portfolio, which is almost 9% of the fund on a nominal basis. And then effectively you can see some of our underlying positions. So if we first of all just look at the red line, which highlights our offshore exposure, you will recall that we have favored a lot of the high quality offshore earners, both in the resources, precious metals, and in the industrial rand hedge sectors. And you can see mining and resources making up 13%, which is largely our PGM and gold positions together with some of our diversified miners. We also have some gold and platinum ETFs in the portfolio. Our foreign JSE listed companies, a big slug of capital at 16%, and that's principally NASPAS, British American Tobacco, Raynet, and businesses which we think are high quality businesses where We think that they'll continue to grow, and you are able to buy into these businesses at discounts to their underlying intrinsic value, and that these businesses won't be affected in any way by the domestic economic backdrop, which we think relative to what you're going to see globally is probably going to be worse. Our foreign equity of 17%, we were doing some bottom feeding in terms of picking up some stocks which were sold down in the crash, but against that we've got hedges on the S&P, so our net foreign equity exposure sits at just about 10% of the fund, but we continue to look for shares which have been oversold and where there's a lot of bad news which is priced into those multiples. Foreign bonds at 8%. We've got some dry powder, our foreign cash at 8%. So if you just look at the foreign assets, the cash, the bonds, and the foreign equity, we've got about 33% of the fund directly offshore, and then the balance of that is through our local rand hedges. Domestic industrials and financials making up 13% of the fund. We've been very cautious. We've got very limited exposure to the local economy given the backdrop that I've just taken you through. And what we've tried to do here is focus on businesses where there's either self-help, where they are restructuring, and where we think they can still grow earnings over the next 3 years, notwithstanding a difficult economic environment. And some of those businesses, there are also second derivative rand hedges. So, a quality focus in the portfolio. I think the other point to mention to you is in times like this, you want to have higher quality in the portfolio. You want to have businesses which have got lower leverage, in other words, lower debt, because clearly there's been a big interruption in terms of cash flows, and one doesn't want to be in a position where, the businesses can't repay the obligations that they need to. Domestic bonds and cash making up over 21% of the fund. We remain fairly short duration on the short end of the curve. Would be rebalance in the next 5 days if we do have a bit of a spike in the rand, as well as our fixed income markets. Tactically, we might use that opportunity to buy into some of longer duration bonds, but we remain cautious given the fiscal deficit. And finally, property, very low in the portfolio. We did buy 1 or 2 names on a very selective basis, most of them being higher quality businesses where share prices have been decimated. More on a tactical view than of anything that's fundamental. We think that the property sector is in severe distress. You would have seen that most or the REITs have applied to the regulator to ask if they can pass on dividends for the next 2 years as they try and rebuild their balance sheets. So unfortunately, what you're going to see in that sector, and it gets back to one of the points that we were talking about last year and 2 years ago, is a lot of these property REITs have got a lot of debt on the balance sheet, and the values of those properties are coming under pressure as rentals are declining and cap rates are rising. And now these companies are facing a loan to value ratios where they're potentially breaching their covenants. So the only way to fix their balance sheets, because they can't raise new capital in the market because it's closed, is to stop paying dividends. And we think that that's highly likely. So from a property perspective, if you're expecting income from a lot of these shares, you certainly think we think you will not see it for the next 18 months at least, until such time as things normalize, if they do, and secondly, to the extent that these companies can repair their balance sheets. So from a portfolio point of view, we are very much in the defensive mode, but optimistically looking at opportunities given the volatility in markets. The next point is to say we've upped the quality of the portfolio, making sure that the businesses that we've got do not have leverage which is unsustainable. All the businesses have pretty appropriate interest cover. There's no imminent refinancing or funding needs for any of these businesses. And the businesses which we've got, we think will be able to weather the storm in terms of until such time as things get back to normal. And then, as you can see, we've got quite a lot of dry powder. So we've got quite a lot of cash that we are able to take advantage of what we think is going to be higher volatility going forward. So we think all of that should translate into the ability to take advantage of these opportunities and take advantage of prospective returns in financial assets, which are much higher than what they were at the start of the year, given the extent of the corrections that we've seen in a lot of these global assets. But I think certainly with a cautious backdrop. So that's probably a quick summary of our positioning. I'm happy to take questions, David, if there's questions that have come on the line.
Fantastic. Thanks very much for that, Iain. I'm just scrolling through some of the questions here, and there are a handful that talk about the impressive performance of the fund and aimed at where a lot of this resilience is coming from. And I guess maybe the read through here is what have been the main positive contributors, as well as what has protected capital through over the last quarter. Maybe you can touch on some of that.
Okay, so I think that's a good point. I think the first point to pick up on that is you'll recall at the beginning of the year, given that markets and offshore markets, certainly the S&P, we felt was very expensive. We bought some very cheap protection. So we bought a significant amount of put options on the S&P, which we felt was the most expensive market. And those options we bought at a fraction of what you would pay for them today. So in other words, volatilities that we paid, the price we paid for that protection is probably 15% of what you would have to pay for it today. So that has helped the portfolio, and it helped sterilize some of the negative beta when markets reprice. But I think on top of that, our quality focus and the focus away from a lot of the domestic financial and industrial shares, which have come under a lot of pressure, has helped the portfolio. So we've had very little exposures to SA Inc. assets. We were very short duration, so we weren't exposed to the All Bond and to bonds which, obviously blew out, and you had minus 15% returns in March. And that obviously helped us. And then the quality of the shares that we've got. So we've specifically, over the last 18 months, tried to steer clear of businesses where leverage was either too high or where there was significant PE multiple risk. In other words, the PEs of these shares were not pricing in enough of the bad news. And I think a combination of our quality holdings, some of our resource names, the PGMs, our gold positions, which have done fantastically for us, have really managed to protect and insulate the capital value for our investors whilst we wait for things to normalize and give us opportunities to redeploy, what is a significant amount of cash, what we've got sitting on the sidelines waiting for opportunities.
Great, thanks, Iain. Another question here refers to the health of balance sheets and needing to be repaired. And you did touch on the property sector and certain mechanisms, or like withholding dividends, etc. And the follow-up to that question was, how would the asset allocation change to reflect this flow of money? So what would the evolution of the asset allocation in the fund, or what can we expect from that going into the next few months or so?
So I think what you can expect is, as and when we see opportunities, and I think it's fair to say that the volatility is significant in our assets at the moment, is when stocks are sold off aggressively, we are going to take advantage of that volatility. So I'll just give you an anecdotal example of what we had is 3 weeks ago, when we were in the middle of the crash or of the reset, Capitec went down about 60% over 2 or 3 days. Went down from 1,100 Rand to about 650 Rand a share. We aggressively, because of our nimble size, were able to move in, build quite a big position in 1 day. Over the next week, the share price bounced 50%, and we were then able to then exit it as it got back to what we felt was intrinsic value. So I think what we are seeing in the market is the extent of uncertainty around what SA corporate profits are going to look like and how SA corporates navigate their balance sheets is creating significant volatility in share prices. And for us, where our focus is understanding the value of assets, once we know what the value of the asset is, asset X is worth 100, as price drops to 60, 50, we are able to buy into it, buying 100 Rands worth of value at 50 or 60 cents, And then as volatility unfolds and that bounces back up, because of the uncertainties and the higher market volatilities, there's opportunities to be extracted from markets. And I think the real opportunity that we are waiting for, and we've seen a little bit of it, is to buy the quality companies at bargain basement prices. So typically the quality businesses over time trade at expensive multiples or multiples which are higher than average because of the quality nature of those businesses. But these sorts of environments reset all asset prices, and you have good shares and good businesses and prices that get sold down with poorer quality businesses. And therein lies the opportunity to, both from a domestic point of view in SA, or to buy into high quality big businesses with proper moats and competitive advantages at prices which are significantly more attractive than what they've been over the last 5 or 6 years. So that for us is the big opportunity. So you can expect, as volatility increases and if markets continue to come under pressure, we will opportunistically continue to build exposure into those assets where we feel there's a lot of bad news that is priced into the share prices.
Okay, thank you, Iain. Sure, there's some great questions here. I wish we had more time. I'm going to ask you just two that I see in front of me. They're quite different. The first one is asking what are some of the international names that you do have in the portfolio, and maybe you can run through that very quickly. And the second one is a little bit more political, referring to the IMF intervention and where does the government stand with regard to unions and the knockback that we might see there and the tough decisions that will need to be made.
Yeah. Okay, so from an offshore perspective, we have been buying into quality businesses where the share prices have come under a lot of pressure. So Vivendi is one name that we've picked up. It's come down from about 30 odd euros down to 20, 19 odd euros. A great business. And Vivendi, if our clients are not aware, is the business that owns the United Music Group brand. And effectively, they own the rights for a lot of music by artists, Rolling Stones, Taylor Swift. They effectively own all of those catalogs. So if you sign up to Spotify, to Apple Music, or whatever it is, every time you access one of those catalogs or songs where they own the rights, they get paid a little clip. So it's a fantastic business. Tencent bought 10% of the United Music Group business from Vivendi for about 3 billion euros. And effectively, we are getting all the other assets in this business for free. It's a great business, trading at a big discount to its intrinsic value, and it's one of those high-quality businesses which we think now, given the market conditions, has given us an opportunity to buy into a compounding business at a very, very cheap multiple. So that's one example. We've got Philip Morris, which has held its own relative to a lot of other global shares. We built selectively some positions in some oil companies, Total and BP, during the midst of oil, which was sold off to record low levels. We think that the oil price is unsustainable at these levels. We built a position in NetEase, which is a Chinese gaming company, which has also done fantastically well for us during this volatile period. And I think really the focus from an offshore perspective has been exactly what I've said domestically, is focus on businesses which have got sustainable cash flows, where the dividends are, to the extent that they're paying dividends, are attractive and sustainable, and where the business models we feel are able to continue to grow or normalize in an environment of high volatility. So those are a couple of names which I've given you from an offshore perspective. Domestically, from a union point of view, and I think if we have an IMF intervention, effectively what happens in that environment is you hand over control of the economy to the IMF. They bring in their team of experts and they provide you with funding, but only under certain conditions. So in that environment, the likelihood of social and labor unrest is probably high. But I think to the extent that we have a crisis now, we would also think that it does give government leverage to take some hard decisions and try and negotiate better wage deals with the unions, because now clearly it's a different set of circumstances when people don't have jobs, and you are saying to unions, guys, if you don't take pay cuts or decreases in terms of the increases that have been agreed, the likelihood of further job losses, those probabilities just accelerate. So I think a good crisis is something that should never be wasted. And I guess the question is now, does the government have the appetite for some hard decisions? If they don't, then we firmly believe that we are on that slope of a debt spiral, and which means at some point we will need an intervention. In that intervention, you are likely to see much, much higher levels of social unrest and kickback from what is a very powerful lobby group being the unions.
Great, thank you. And I think the two key takeaways for me from that are, and I'd heard the rumors that you were a Taylor Swift fan, so thank you for that verbal confirmation. The second, they've probably perked up a few ears with the oil companies that you bought into. So what we might do is put a little note together and send that out to all the clients subsequent to this call at some stage in the coming days. Unfortunately, we do have to finish the call at this point. So thanks again to you, Iain, for taking the time out of your morning today.
Brilliant. Thanks, David, for the invite, and I hope everyone has a good weekend and stay safe.
And of course, thanks everyone who dialed in and joined us from their homes across the country. I'm sure you found Iain's insights incredibly helpful as always. A reminder that this call is, along with all the previous ones, being recorded and are available. So please do get in touch with your Nedgroup Investments Relationship Manager should you wish to have these. And please join us next week for further fund update presentations. I believe we will be taking a deeper dive into the Nedgroup Investments Rainmaker, Entrepreneur, Property and Global Equity Funds. So on that note from me, thanks again, take care and enjoy your long weekend.